All right, so today we are going to be talking about risk in real estate. Risk and reward are two sides of the exact same coin. We cannot have one without the other. So we're going to be talking about how do we define risk in our real estate investments and how do we control that risk so that we can make sure those returns we need in our investments are there and minimize the chance of taking those losses that set us back potentially years. So let's get into it. Let me give a brief background though for the new folks out there. I've been a full-time investor for about 15 years, give or take. I'm out in Pittsburgh, Pennsylvania. I have no idea how many houses. I have 7 right now. We've been doing that constantly since the beginning. I have a rental portfolio of 306 doors that we've built since 2020. So we did all that during COVID. And I am a partner of JJ's in Always Capital, which is our private lending fund as well. So we're more on the lending side at the moment, helping other investors fund those deals and be able to get out there and do the things they need to do. But my point of view is that of a investor who has become a lender. And so that might be a little different than what you'd hear from pretty much anybody else. Most of the time, if somebody's speaking, it's a pure, I'm just a lender, I'm just a borrower, I'm just an investor, that kind of thing. I have a little bit of a different path there in that I do both. And I do this stuff very actively. So today, we're going to talk about risk and what that looks like. So what I recommend you all do, I could have made a pretty PowerPoint and everything, but I didn't. What I suggest you do instead is grab a physical notebook if you can and a pen. The physical act of writing notes, it hits all 3 learning modalities, your visual, auditory, and kinesthetic, and maximizes your ability to retain information. This goes for anything, not just this. So I am a huge fan of taking notes, even if you can't read what you wrote and will never read it again. The act of writing it helps a great deal with your retention. So I'll go through a bunch of risk stuff today. You guys will be able to ask me any questions you want. Fair warning, I will answer them. So be careful. And we'll see if we can't give you some value as far as how we look at these things going on. Tell me what risk is. What does it mean to you, risk in investing?
To me, risk is being willing to do something that you could lose a lot from, but you also could gain from.
Yes, yes. Risk and reward are like 2 sides of the same coin. If we reduce one to 0, you have definitely reduced the other to 0. Absolutely. Thank you, Carla. It's a really good definition. And I see in the chat, a lot of you guys are saying basically you're looking at risk of loss. That is one form of risk we look at. We break it into a lot of little subcategories. And as an investor, we all have what we call a risk profile. And this is unique to you as an individual. I'll give a simple example there. Let's say you are at retirement age. We're 60, 65 type age. We've worked a job since we were 15 or 16. We've picked up and put together a fairly okay size retirement account. Nothing too crazy, maybe a couple $100,000, not necessarily tens of millions. And we figured out after doing the math that we don't have enough money to stay alive for another 20 or 30 years at the standard of life we'd like to have. And so we're going to need to take that nest egg we've built and we got to invest it for a return, which means we have to put it at risk. As you might imagine, we don't have time to make that money again. So we have to be really conservative. We can't take a risk of loss on that money because it would be catastrophic to us. All right, so that's a risk profile for someone a little bit older. Somebody younger, broke college student, just getting into this real estate game, has nothing but credit card debt. If they make money, lose money, whatever, it barely matters because they can do it again next week and they can keep playing. So that's very, very different risk profiles. So it is worth your time to sit down and figure out what is your risk profile. What do you, of the capital you have available to invest, how much risk are you willing to put it at? Is this same as risk tolerance? It can be. It can be. You can different words for kind of the same thing. If we want a return on an investment, we have to take a risk. Anybody who says that a risk is something's a zero risk deal is either lying or it has no return attached to it, right? There's very, very low returns. So if we want those higher returns, we have to take risk. And risk of loss is the one that you guys think about the most. We put our money into the deal and not all our money comes back. That has various levels. So when we invest in a deal, we're looking for a return. And so the first level of loss, the first level of risk on that is risk of getting the return. So if I put $100,000 in a deal for a year and I expect a 10% return on that, I'm looking for 10K. There's a risk associated specifically with that 10K. If I don't make the 10K, but I get my 100 grand back, that's not as bad of a risk as if we have a risk of principal loss. Okay? So we break it up into fine little details like that. Another thing we'll look at, or here's a simple bit of math for you. I put this, we have the new group that you guys might have seen JJ was talking about. We have our Equity Investing Done Safely group. We're going to be doing a training in that next week. If you want to join, reach out to JJ. Belle probably has a link to that post she can put in the chat for you guys. So if that's appropriate for you, if you're going to do equity investing or private lending, that is a training specifically for that. We're going to cover this stuff in a lot of other deep detail. So if we have $1 and we invest $1 and we don't get it all back, we take a little bit of a loss. Let's say I lost 10%. I'm losing 10 cents. On the remaining 90 cents, I need to get an 11.34% return to get back to $1. Let me say that again. If I take a 10% loss, I lose 10 cents of my dollar, I have 90 cents left. I have to get 11.34% on the remaining 90% to get back to $1. Does that make sense to everybody? Now that math gets exponentially worse as we go up. At a 20% loss, you'll need a 25% return. 30% is 43% return on the remaining capital. 40% loss is 67. By the time you lose half the money, you need 100% return on the remaining in order to break even. 60% loss is 150%. 70% is 233. 80%, you need a 400% return on the remaining principal, and 90%, you need a 900% return. And obviously, if you lose it all, the game is over. If we think about the kind of returns we can expect to get in real estate, realistically, and a risk profile we could possibly control or tolerate, your returns are going to be between 10 and 20%. Anything higher than that is probably too high risk for us. That means that to get your money back within a year or two, you could not tolerate a risk of greater than a 20% principal loss. Does that make sense to everybody? I know it was a lot of numbers, but they all mean the same thing. The punchline is that it is more important for us not to lose the principal than it is for us to get a return. You can't take a loss on the principal. We really, really need to keep that safe. If I translate it to time for you, if we assume we're getting a 12% return per year on our money, a standard type investment you would do in real estate, either as a private lender or that's approximately the return net on an average rehab after taxes. So if we did all that, we get a 12% return. That would mean that if I took a 10% loss on my principal 1 year, then it would take me a year to get that back. If I took a 20% loss, it would take a little more than 2 years. So it's a very, very bad thing to take a principal loss. And for most of us as investors, that's an unacceptably high risk. All right, so that brings me into the time risk. There's another one for you. Everybody talks about the risk of capital loss. We also have how long it takes. So if I get a 100% return on my money, that's awesome. But if it's at 1% per year, that's a little rough, right? So how long is the capital going to be out for? How long is this investment supposed to take? And what is the risk of that time going longer? Normally, when we're looking at time from a risk point of view, longer is worse. Though in buy and hold, it gets a little funny because appreciation offsets it and it actually makes it safer. So that tends to mess with it a little. But when you're looking, especially at short-term type investments, longer is usually worse. So your fix and flip renovation projects, those will usually take 6 to 18 months. The closer you are to 6, the better off you're going to be. And out of the last 4 or 500 I've been involved with, we average 9 months. So when we underwrite and look at them, we're generally looking at 9 months for to do one of those. So that's how long we expect our money out. That means if we're turning our money as an investor, you will turn your money 5 times every 4 years. Let's talk about exposure. Exposure has two sides. There's exposure on the project, and then there's exposure to you as an individual investor or against your portfolio. So if I have a property, a project that we're going to do, we're going to buy it, rehab it, hold it, whatever, it doesn't matter. And that's $100,000. The exposure on that is 100 grand. If I am investing, because I have lenders or whatever, I have a first position lender giving me 80% of that, then my exposure as an individual investor is $20,000 and their exposure is 80. So they have an 80% exposure on our deal. We have a 20. And you can break that down, but the number always adds up to 100 every time. So there's exposure on the project. Then we have exposure on our individual portfolio. If I'm investing out of my available capital and I have $100,000, if I funded that deal, then not only have I funded 100% of it, so I have 100% exposure on the transaction, I also have 100% exposure on my portfolio. That is usually considered very high risk. If anything goes wrong with that project, I am completely exposed and taking all the damage. All right, so we look at both of those things. What's your individual exposure and what is the project exposure? Just how much of your stuff is out there and how much of your stuff is on that deal. Now, when you're just starting out and we only have so much cash, you probably are going to have 100% exposure from your own available capital on a deal. That's pretty normal. But as we go further, we want to lower that risk, and we do that by spreading the love around a little bit. If I have $100,000 to invest, it would be a bit of a preference to do two $50,000 deals rather than one $100,000 deal. The more we can spread the love, the better. So that's exposure. That one's easy. Time's pretty easy too. How long do you expect it to be out, and what do you consider the risk of it going longer?
Hey, Brian. Brian, I had a question for you about life insurance.
Mm-hmm.
Now, there's some strategies that I've come across. People are using life insurance. I don't know too much about it yet.
They usually call it infinite banking.
Okay. And investors using that life insurance, to fund deals and all that kind of stuff.
You can, yeah. It's a capital source that can work. What usually happens, it's basically an arbitrage play. And in the current market, it's probably not nearly as sexy as you'd want it to be, because what happens when you buy a whole life policy is first you got to buy it. You pay it off, and there's a bunch of different ways you can do that. You can finance it. Banks will fund them. But you buy the thing and you own it outright. And they need to be kind of customized for this purpose, meaning they usually have a really low death benefit, but a really high cash value. So they're designed as an investment tool. There are fees attached to doing it this way because it's really not supposed to be. That's not its purpose. So you have to make sure the fee structure makes sense. But what they do with that policy, insurance companies are actually investment companies. They don't make their money from your premiums. They make their money from investing your premiums. They don't care about paying out because it's just a principal play for them. So what happens is you buy this cash policy for whatever, and then they're going to go invest it, probably in something very conservative like the S&P 500, which is going to return somewhere between 4 and 8% per year. and they're going to get that all day, every day. So if you don't mess with it, that's the returns you'd get on that policy. So when you pull that capital out, you're going to pay the associated fee structures. You're taking an opportunity loss on that kind of guaranteed percentage. And then you're going to go ahead and invest it, hopefully for a hell of a lot more, and be pleased with the risk you're taking to do it. So yes, it can work. According to some insurance friends of mine, it worked a lot better when the interest rates were lower. Does that help?
Thank you. Yeah, thank you for sharing that. Appreciate it.
Mm-hmm. Sure thing. Yeah, so that's a fun strategy, guys. There was a time, not at the moment, as far as I'm aware, there was a time when you could finance it and actually get the arbitrage between the financing you got from the bank and the returns that the insurance company got you, even if you didn't pull the cash out, and it would pay for itself eventually. But the current interest rates, from what I understand, and the current returns in the stock market are not high enough to justify that investment strategy just now. So anyway, lots of cool stuff out there, but those are subject to market changes.
Hi, Brian. I am curious in regards to what is in the knowledge you have in regards to lending, what is your favorite and most lucrative move?
So yes, what is the most lucrative move you can make? And that actually dovetails, Michelle, very nicely into the entire topic I'm having here. The goal is, what is the most lucrative move I can make within a risk that I consider acceptable? Because you can do some pretty crazy stuff, but we might as well be sitting at a table in Vegas, right? So for me, my personal favorite at the moment, that is not completely passive, but fairly close, is I really like being the equity partner to an experienced rehabber. It's a great way to do it. So we have them use a first position lender on their rehab. That's usually me. We get them about 70% of what they need. I come in as equity for the other 30%, and I take 30% of the deal. And so it's pretty easy. They do all the hard work. I write the checks, and I get paid at the end. So I'm a big fan of doing that one. But we're going to talk about the risk control on that quite a bit. If you want to learn more about that, that is actually the primary topic of our equity investing group that we just created. So if you check your chat there's a link where you can ask to join that. And then JJ is going to want to talk to each and every one of you. He's directly interviewing everybody involved before they come in that group. We are not charging you anything, though. I can promise you that. We're not selling anything. There's none of that nonsense going on. We just want to make sure that you're coming for the right reason. So let's talk about the loss risk. That's the one everybody wants to know. So exposure, we talked about. So that's how much of the individual deal are we on? Like what percentage of it are we invested in? And then we have personal exposure, which is what percentage of our capital is in that deal. The lower we can get those numbers, the lower our risk. The higher those numbers are, the higher our inherent risk. 100 is the roughest one. If I have $100,000 to invest and I do a $100,000 investment, I am completely exposed. I win or lose based on this transaction. So if anything goes wrong with it, I get burned alive. And if it all works, hopefully the returns justify it. So that's the exposure risk. Time risk. How long is this deal going to take? And what are the chances of it taking longer? Generally, the longer they take, the worse it is, with an extremely notable exception of rental property. Rental property, the longer it goes, the more it's worth. We have both the cash flow to offset the holding cost and the appreciation to reduce our exposure because it gains equity over time. So, but on all your generally shorter is better and longer is better on your buy and holds. So let's dive into risk of loss. There are two fundamental types of real estate deals that we do. We do construction projects of some sort, some type of equity improvement. And that can be a ground up construction, a fix and flip, rental turnover, whatever. but it involves taking a property that probably is not in the greatest shape or doesn't exist yet and building it and making it nicer. And we invest in that project. So that's version 1. And version 2 is buy and hold. So we're going to put a tenant of some sort in that place and be paid regular income for holding that property. Almost every single real estate transaction you will ever see is some version of those two. So you can just break that down. If I'm buying a skyscraper, that's a form of a buy and hold. It's a commercial building. I'm going to put businesses in there. They're going to pay rent, and I'm going to cash flow it. And that's how I'm going to make money by owning that. At the same course of action, I could pick up a beat up warehouse, convert it to an apartment building, and then sell it. And that would be a fix and flip type project. You can also combine these two where you buy it, fix it, and then keep it. But fundamentally, that is your two projects. They have two different risk profiles. The risk in your construction is the construction, is the actual fixing of it. Who's going to do it, the materials, the permitting process, and all the things involved. That's what they base every one of those house flipping TV shows on, right? Somebody, they put a camera crew in there and, oh no, there's termites behind the walls. We didn't know. That's actually not how any of this works, but they make the drama out. The risk is that, among other things, contractors are people, and they may or may not be reliable. Material costs can fluctuate. We see this a lot with lumber in the last handful of months. And then you have the third parties, local governments, that will add permitting processes and delays and all that kind of thing. Those are all very real risks that are inherent to construction. There's nothing wrong with them. It's fine. We need to be able to control those risks. The number one way we control that risk is experience. Write that word down and then hate that I don't have a better answer for you. The way we deal with these unknowns is by learning them, by knowing them. How long does it take to get a permit to put a new deck on in the city that you are operating in? You can ask, and somebody can give you a educated how long it took them to do it last time, if you ask the right people. But until you go get that permit yourself, you're not really going to know. And so direct experience is the number one way we offset this risk. How do we deal with a contractor who goes bad and goes off the job? My first mentor said that contractors are like gallons of milk. Even the good ones go bad. And throughout my career doing this, I've never had a contractor I worked with more than maybe 4 years before something changes and they either retire or maybe they change a couple of guys in their crew and they're not so good anymore, or they made enough money this week so they're just going to go on a vacation for 6 months and not bother telling anybody, or they get arrested, or any number of other things we've seen happen to contractors. But the chances of a contractor being a long-term part of your business are pretty low unless you happen to be a contractor. And so then how do we deal with that when we lose a contractor on one of our projects or a sub doesn't work out? Well, that's our network. We're going to need to reach out and be able to get somebody else. You're going to need somebody else. And it's experience to be able to do that. When a new contractor comes in on an old contractor's job, give me a react if you guys have ever had this happen. The first thing that contractor is going to do is tell you the other contractor did everything wrong and was ripping you off and they need to redo it all. We see that happen about 90% of the time. So changing contractors is not as simple as I had $10,000 in labor to do. 5,000 of it got done by this guy, and then I had to fire him or he walked off the job or whatever. And now I hire a new guy and there's only $5,000 left. The new guy is going to want 8 to 10 to do it. Because that's how this works. They're going to blame the other person on it, right? They're going to have to redo the work. Sometimes that's true, and sometimes it's nonsense. But either way, it's going to happen. And it's going to happen damn near every time. So experience, having multiple contractors you can call upon, having subs who can back things up. You can use yourself if you know what you're doing. It's usually not highest and best use of our time to swing hammers in our own properties. But I can tell you that for a while, especially during COVID, I got really good at painting rentals because what they were charging for interior painting was so crazy. I'm like, I'll just do it. It's cool. I mean, I can spray white paint over outlets and cockroaches as easy as anybody else. Why should I pay a couple $100 a room for that? So you need a way to deal with the contractor problem. You're going to need a contractor who can do this project that you're working on. You need a backup contractor for if and when they fail. And you're going to want to line up contractors for the next ones. The only way that you're going to do that is experience. We have our Dealmaker boot camp and picnic coming up Friday and Saturday there. We're charging an insane price tag. It's like $77 a person. We're not making anything on this. We're doing it to cover the cost of the thing, and we're donating the difference to the baseball team. Okay, so we're not here to take advantage or anything. We're covering our costs, not really, because we're even feeding you lunch. We're going to get you guys some really, really good info and take you through this with a lot more time than we have on these calls. It's really easy. I get paid when you take a loan off of me, and you're only going to do that if you have a deal that I can fund. So I might as well show you how to do that part so I can get paid. So it's a multi-step process, but we're working on it. So thanks, guys. I look forward to seeing you in a couple weeks.
I try to get you on your agenda or the bullet. How many main topic you're gonna share with us. And before you jump the deeper, I have a quick question about the property. You mentioned the two risk. I want to say the property risk exposure is specifically on fix and flip and specifically maybe like on JV partner or something like that, not just a capital lending risk, something like that. Could be involved in the operation or like partners. You might have an opportunity to talk about that topics later on, or maybe you might have a case study with us. That would be appreciated.
Yeah. So I point, if you're going to be the joint venture partner, if that is a thing you want to do, that's the new group that we've been talking about, the equity investor group, that I'm going to be doing a detailed training on that first one next week. It's probably going to take about, I'm guessing, 6 hours to teach you everything. So we'll probably do 3 2-hour sessions for free on Zoom. But
on Zoom,
yeah.
by JJ's group or another.
You got to contact JJ to get put in it. He talks to everybody directly about it. But
Okay,
yes,
cool.
we're doing that. That's specifically for investors and lenders. And one of the big topics that we'll cover there that I'm touching on a little bit on this topic because it's all related, but it is how we identify what we call the operator, the investor who's going to be doing the project. What are the things we're looking for in them that control our risk?
Okay.
Because if we're putting up the cash, then we're trusting this third party to do the investment and have it work. So what are the things we need to look for in that third party so that we're not at uncomfortable risk and those returns are really going to be there?
Right. So maybe not like just capital lender. We might involve some business strategy, or decision making, like a JV bank account management or material, cost or purchasing, those details.
Yeah, those kind of things are that's specific to I'll give you a really simple analogy. It's like dating and getting married. So the first deal we ever do, that's like going out on a blind date.
Okay.
Except you're buying dinner.
Okay.
So whether or not that works out.
Talk about that the next weekend?
Yeah.
Okay.
Yeah, we'll get into that. We dive into it, but basically you start out with a relatively loose partnership. We might just do a joint venture agreement or temporarily be on the LLC through an operating agreement. There's little ways like that.
Join our Wyoming holding company into JV.
Correct. Yeah, there's a bunch of ways to structure it, but we're going to generally operate as an LLC and then it'll hold interest.
Yeah.
But yeah, you do that stuff. But then if we have if the partnership goes well, and obviously we want to do it again, right? Everybody made money, everybody's happy.
Yeah.
Then a more permanent structure with better tax advantages gets set up.
Awesome.
But yeah, at first it's a piece of paper and a signature. We make it pretty easy.
Yeah.
Does that help?
Appreciate it. Yeah, let's continue. Thank you.
I see a question in the chat here. What are 2 to 3 key ways to vet contractors? Contractors are kind of like the worst part of the business in my mind. I look for ones who are more experienced. I tend to prefer to work with the older guys than the younger guys. There are a few exceptions to that. One of the ways that I like to find them, this was actually the first way I was ever taught to do it, and it's worked pretty consistently for more than a decade now, is to show up at Home Depot or Lowe's at 5 in the morning. So between about 5 a.m. and 6-ish, I sit at the pro desk with a couple of coffees and some donuts, and the contractors who are showing up to get their materials for the day, just by being there, they tell me a couple of things. One, they have a job. That's awesome. 2, they show up on time. And 3, they have enough control over funding to pick up materials. So that already kind of raises them above the minimum. Then we look for, in some states, there's GC licenses and that kind of thing. I look for people who are insured. It definitely, as an investor, we can get some under the table uninsured labor a lot cheaper, but it's not often worth the liability that is associated with that. So those are that's kind of been my sort of go-to when I'm out of contractors way to go do it. I just go hang out at Home Depot or Lowe's a couple of mornings and see who is there. Good contractors are busy. So if they're just sitting around doing nothing, that's a red flag to me. And then obviously your network is going to tell you at least who the bad ones are. But licensed, insured, and it's not their first job is a pretty good way to go about it. Another thing that helps quite a bit in controlling the contractor risk is your lender. So when I fund a rehab for you, I don't care if you have 0 experience or you've done 100 of these, it works the same way every time. I'm going to fund 100% of your renovation. But I'm not going to give you any of that money. So if you're doing a $100,000 job at closing, you're going to receive nothing. The way it works, you go and do some item out of your scope of work. Let's say you're putting a new roof on for 10 grand. So you'll go get your contractor to pop the roof on there. You'll pay for it. And then you'll call me up and say, hey, Brian, we got the roof on this thing, and we'll do an inspection, or maybe have you do a FaceTime with us or something. There's a bunch of ways we can handle it, but I want to see a new roof correctly and legally installed with permits. And once I see that, I'm going to wire you over 10 grand, and then you're going to do it again. So you can blame the lender, and what we do is force limit your exposure. I won't give you enough money to lose. You only have the amount of the work between draws. From a risk point of view, when we're talking about construction, the most dangerous time in the project is the middle. At the beginning, we haven't really done anything. There's no investment yet, so don't really care. If the project failed at that point and we just sold it, it'll be worth what we bought it for. So that's okay. It's when we're about halfway through that we risk the highest amount. At the end, when we're down to just simple little punch list items, it doesn't really matter because I could get anybody to go in and do that for a very small amount of money, or even sell it incomplete without a big hit to the value. So your problem is in the middle. The draw system that lenders are going to force you to use limits your exposure the whole way. And that helps you quite a bit. So that is a risk control for the lender, but it benefits the investor too. The more detailed, again, there's some blame the lender stuff here that's really powerful for you. The more detailed the scope of work that you give to the lender, the better off you're going to be. We usually want it divided into labor and materials. And if you do it by little line items, you're better off. I'll give you a simple example. If you tell me in your scope of work, I'm going to put a new kitchen in for $15,000. And then you call me up about 2 weeks later and say, hey, here's the kitchen. I got a couple of the cabinets installed. We got the floor done. The appliances haven't come in yet, and the countertops are on back order for another 6 weeks. Can I get a draw? Well, you haven't finished the kitchen. It's not done. There's nothing to give you. And so partial draws will work with you. Lenders will do that, but it's not nearly as clean as if you had order the cabinets. We expect the cabinets to cost this much. Install the cabinets. We expect that to cost that much. And you have it all broken down. Then I could look at all the little things you've done, even though they're roughed out, and we just check off the boxes and be like, this is how much I can send you, right? And if you get in the habit as an investor, as a lender, the more detailed that is, the easier it is for us to operate. Here's another magic trick for you. The value of your property is ultimately determined by the appraiser. It's not your comp package, it's the appraiser that is going to decide what that thing's worth. And when you go to sell it, it's your buyer's appraiser who's going to decide what the ARV is. When we get an appraisal done for a renovation project, we include the scope of work. The more detailed the scope of work, the better the value they're going to give you. If it just says clean the place up, pop on a new roof and paint it, that's not going to change the appraiser's opinion of value very much. If I instead have the whole thing broken down item by item by item, they're probably not going to be bothered to read the whole thing, and they're just going to give you the number you want, right? It helps. So more detail in the scope of work. It's a very good habit to be in. Your lender will thank you. Your contractors don't want to do it. Do I have any contractors on the call? I really don't mean to be bashing you guys. If you're here, you're not the kind of contractor I'm talking about.
I thought Ryan just talk about that on the detail, like, how to work close to the general contractor, material and timing. And so if we might have like, what if, as I go through the post-morbid, the JV lender, the video, he talked about a lot of the what if. Think about, more than 10 what if to upgrade my, agreement. What if like over budget? What if over project timeline? And those kind of things. You might have some, some thought to share on that?
The way a lender looks at it,
Mm-hmm.
we look at the borrower's liquidity.
Okay.
That's the simple answer. When there's a problem, how are you going to pay for it? Because I'm not. I agreed to give you this amount of money, and that's a one-time ask. We're not going to modify that amount. Coming to me and asking for more later is a major no-no. That's a big faux pas. That doesn't look good to anybody. So then I want to know, okay, so when your $50,000 scope of work ends up being $70,000, who's got the other 20 grand? How are you going to handle that? When we thought this project was going to take 6 months and we're on month 13, how did you afford the interest payments on my money up until that point?
That means money.
Right? Yep. And that's why they want to see liquidity. They got to have some kind of cash. Now, if we're coming in as an equity partner, it's a bit of a different story because you're being that liquidity.
Right.
But then you have the same thing. Can you afford the project?
Right.
Can you make it okay? And there's a scale that we actually operate on here. At some point, it's cheaper to sell it than to continue with it. So we get into that.
Strategy or any tip to avoid, to do something upfront to avoid a kind of, those drama. Not that.
It's all part of the agreement. And yes, you do everything up front. There is no confusion. As an equity partner, what happens is really clear. They screw up, you take over the LLC. It's yours now. So now you're the owner and you can operate the rest of the project however you'd like. Usually we finish and sell it is the typical answer. Though occasionally you keep it. So it's up to you. Okay. So but yes, all of that is structured at the either the loan document level or the operating agreement level, all of it. And whoever is writing the biggest check makes all the rules about all of this.
Last quick question. As the equity partner or JV partner, as long as check it out, the project, progress how often to follow up, the project, or I mean general contractor job, like every week or every few days?
It is the job of your operator to do that. As the
Mm-hmm.
equity partner, I would want a decent enough update. But there's a really simple one. If you're the one paying the cost of the construction before the draw comes in, have they asked you for money in the last 2 weeks? Because if the answer is no, it's a problem. And when they ask you for money, you should ask the exact same thing the senior lender does. What was done? What am I paying for?
Right.
I got to put new floors in. It's $5,000. Okay, no problem. It's in the scope of work. Here's $5,000. You advance
Right.
it to them.
Right.
And in a couple of days, I expect to see pictures of shiny new floors that look good,
Right.
and that's done, and we're doing a draw on it, and they should be coming back and asking you for more money.
Okay.
Right? So if you don't see a draw request in too long, that's a red flag.
Right.
Project needs to be moving forward, right? So yeah, I would say it's every week or two. When we look at, and this is almost an entirely separate topic, but it's one worth touching on here a little bit. As an equity partner, the most important component for you guys is going to be the operator, the person or people doing that renovation, who's managing the contract or who found the house in the first place and dealt with all the nonsense associated with it and selling it at the end. That's not your job. Your job is to write a check and look pretty, and you only have to do more if they screw up. So we actually are going to be very unhappy if we ever have to do more than write our check and collect our check.
Right.
So who that person is, super important. The number one thing for them is, what is their experience? If they're a brand new investor and they've never done this before, but you guys are in the same education program, you're in the same community, you really hit it off, and you're willing to work with them on it, then our recommendation is you need physical proximity to the project. You need to be able to drive to it and do it, potentially take it over and do it yourself if you have to. That's how we control
Okay.
our risk. If they're more experienced, it doesn't matter at all where they are.
Okay.
So
Personally, how do you trust, like nowadays, like a virtual, devices to check it out, or in person? You prefer in person, physically check it out?
if it's a brand new investor that I've never worked with before and has zero experience, then I want to physically be there. In
Okay.
all cases, every case, we're not going to be first position as an equity holder. There's going to be a senior debt lender, somebody like me, and we're going to do professional underwriting on the project, which
Mhm.
means there is actually a house there. They're not faking it.
That's right.
There was an appraisal on it. There was a
Mhm.
scope of work that was given to do that appraisal. A third party agreed upon the valuation. We lent a certain percentage of the money at terms to get all this done. So all that stuff's already in place. So you can be reasonably certain that you're dealing with a decent project just by that. If they go to come to somebody like me and I tell them, no, I won't fund that, then you should probably run. Don't walk away. That's not the kind of deal you want to be on, right? If we won't fund it, I suggest you be out. Otherwise, you are operating outside of our risk profile, which is probably quite a bit more tolerant than yours. So we do not recommend. If we follow the systems, here, I'll give you guys a little bit of, you want some statistics? If you follow our underwriting systems, you have a 0.7% chance of failing on a project. If you go outside of those systems, even just a little bit, it doesn't go up to 1, 2, 3%. It goes to about 30, and it goes there really fast. And as the chance of failure increases, the size of the failure is also likely to increase. So you are more likely to lose, and you are more likely to lose more.
A lot more.
Yep, it gets bad. So question, how do we get access to this underwriting system? Really simple. You use me to get a loan and I do it. That's our underwriting. That's how we go about it. If I write the first position loan, then we did the underwriting. And as an equity partner, you can demand copies of all the underwriting. You can get a copy of every single thing I did, including the background check on your new partner. Want to know if they're a criminal? It happens.
so I have a couple of potential off-market deals here locally, and my brother is an architect as well as a licensed and experienced general contractor. Now, do you or would you um be able to, or do you offer this service to where, like, if I were to connect you and the owner of this property to see if it would be even a good fit still to move forward with? Because I've never done my first deal yet.
Yeah. Okay. So it works a little different than that, but I'll say sort of. Okay.
Mhm.
So what'll happen initially is you will follow the training you've gotten to make an offer. Okay, so you're just going to make an offer. Now, here's a thing about making offers. If you're coming to our Deal Maker Bootcamp, I'm going to pound this into everybody's head for about 6 hours before I make you do it. The offer means nothing. Shut up and throw it out. Make the number, right? It doesn't matter what they're asking for the property. If you think you'll use your template and you'll figure out a scope of work and you'll make an educated guess on what it's going to take to repair it based on the listing or what you saw. You're just make an educated guess. Then you're going to apply your basic underwriting system. Do you guys use the MAO formula? Do you know that one? Maximum allowable offer. It's here. You can write it down. I'll write this down. This holds up really well in any market where the median home value is under about $800,000.
Under $800,000.
Yep.
Okay.
If the ARV is under 800 grand, you can use this without a problem. Otherwise, it gets a little fuzzier. All right. The formula is the ARV, whatever you think the fixed value of that house is, times 0.7 minus whatever you think it's going to take to repair it.
ARV times 0.7 minus what?
Whatever you think the repairs are.
And then minus your wholesale fee also.
If you're a wholesaler, you add your wholesale fee. You subtract your wholesale fee off too. Yeah. It's just a bigger rehab.
So this is for less than 800K on this residential property?
This will work on any property under about 100.
Property.
Yeah,
Okay.
under about 800
What if it's
grand.
over?
Then the percentages get a little funkier. You'll probably end up closer to 73 or 74. So you just take that, and the result that you will get at the end of doing this little bit of math is the maximum allowable offer. That is the most you can pay for the property. Offer a little less than that.
Offer less. Okay.
Just a bit, not a couple thousand off. That way, when they come back at a higher number, you say the best I can do, and you come up a little bit. If you gave your highest and best for the first round, you're already done. You can't do anything.
Okay.
All right. So you make your offer. If they say yes, cool, we're going to contract. If they counter you, then you're going to go out and inspect the property with a contractor, and you're going to nail down your scope of work. Once you have your contract, then you call me, and we begin doing underwriting. And among the things you're going to do is we're going to order an appraisal that you will pay for. It's one of the few things that you will spend money on before you own the property. And that is where we're going to verify that nothing is wrong. Your numbers are actually right, and the whole thing is going to work. If not, we're going to blow it up right there, and we're going to stop it from moving forward. Okay. So if you follow the systems, the chances of you buying a place that you thought was worth $1 million and is really worth 500 grand are pretty vanishingly low. That's not going to happen. It's going to have similar values, and your contract will have done your scope of work, so you're probably going to be okay.
Okay. All right.
So you'll get essentially handheld through it by your lender, but you need your lender once you have a deal. That make sense?
Okay. Yes, thank you.
Sure thing. We have any other questions sitting out here?
There is wisdom in pinning yourself between the two to protect your finances.
Correct. Correct. Let the lender be the bad guy. Go ahead. I have in my career as a lender had to talk to contractors twice. In both cases, they were fired immediately. So it's probably not a great idea for me actually to talk to them, but you can threaten it all day long. Cheryl, you got a question?
With a maximum allowable offer, does that kind of include like contingency fees or anything? Because I know when you
Yeah,
do like the repair estimator and the
yeah,
deal
yeah.
analysis, you put the contingency fee or percentage. And then is there a different percentage? I mean, if you have like a house you're going to flip that has, it's a lot, it's a complete kind of gut.
Mhm.
Are you going to put a higher contingency fee on that than you would something that's more cosmetic?
Yeah. Okay, so let's talk through that a second. Let me answer the first part. What
Okay.
the MAO formula is a shortcut that we can do in our head,
Sure. Okay.
right? We're not closing on it, but the acceptance rate on investor offers, write this down, guys, it'll save you some
Okay.
time. The acceptance rate on an investor offer is 2%.
Yeah.
You need to make 50 of these. My personal preference is not to spend more than 3 minutes making an offer. Don't feel bad if you're working on hour 50 of your first offer. Just don't ever do it again. We look at a property. I flip through the pictures a couple of seconds, be like, it looks like 50 grand. Do the MAO formula, call up the agent. Hey, I'll buy it for this. Does that sound good to you? Yes, no, whatever. And then we move on from there. I'm just done. You make it really simple because there is a 49 out of 50 chance you're getting told no, and you're going to waste your time if you do anything else. So the MAO formula, we're knocking off 30%, right? It's 70% of what we think the ARV is. That is not so you can make 30% on the rehab. That's not how that works at all. Half of that, approximately, roughly 15 to 18%, is holding costs, financing costs, closing costs, selling costs, seller concessions, and all this other nonsense that I lump together in a category I call bullshit fees, and there's absolutely nothing you can do to get them to go away. So if you use the MAO formula, you have a pretty decent chance of having your underwriting in detail come out about the same. So it's enough for us to make an initial offer, and if we have to, we'll modify it later. Second part of your question on contingencies. Contingencies are, I do my detailed line item scope of work. I got my materials, I got my labor, I got it all broken down. And at the end of that, I got some amount of money, right? We take a percentage of whatever that is, and we just blanket add that as a line item at the bottom. And that's so when we find out, oops, there's termites behind the walls, that kind of thing. We have some cash there to fix it, and it's built right into the scope. A completely acceptable line item on your scope of work is contingency. You don't have to pretend it's something else. It's okay. The way I like to do my contingencies, this is a personal preference. You talk to 100 rehabbers that have done this a while, you get 100 different answers. Mine is a scaling contingency. I start at 10% for the first $50,000. I go to 15% up to $80,000. And over 80 grand, I'm doing a 20% contingency. The higher the scope, the more there. Now, to put scale in mind for you, in my part of the world, if I'm doing an $80,000 renovation, that is a fairly large to the stud full rebuild. That's 80 to 100 grand. I'm rebuilding the house. So that's about as big as the scope tends to get for me within reason. But there's a thing called scope creep. Anybody ever hear that term before? This is usually used in the software development world. Basically, the larger the project, the larger the overages. So I scale my contingency accordingly. It also accounts for the larger the scope of work, the longer it's going to take, and the more likely you are to encounter delays. And so now that extra repair contingency might actually be spent paying holding costs instead. But you may very well need it. Bigger projects are higher risk and need a larger contingency to keep everything good.
When a realtor is asking for proof of funds, how do you go about that?
You grab your initial info, you dump it to us, and I'll get you a letter of interest, which is really just a loan quote. and that becomes your proof of funds to submit with the deal. They usually are. There is such thing. It's called a letter of exposure, which is sort of like a blanket line. You don't want to do that unless you are trying like wholesaling stuff where you got to make like 50 offers a day to make it work, because you don't want to show them a dime more than you offered.
Okay.
So, you know, if you just get a blanket thing for 500,000 bucks and you're trying to buy a place for 80 grand, yeah, they're going to fight you. So you want a specific letter of interest for that property at the level that offer is being made at. It's cleaner and it looks better too, because those have a phone number on it. They can call us and we can confirm that pending underwriting, we will fund that amount.
All right. Yeah,
it has some power.
Yeah, I was thinking like in the bridge category or whatever. We've done a bridge before, so we had a big one like that. Just to save time on your guys' side, you know, because the POF can be kind of draining, but
they can, but at the end of the day, it's part of the business, right? You guys
Yes.
need them, and we got to do them. The expectation, of course, from all parties is that eventually one of these things is going through. Hopefully, you aren't hitting me up for 100 a week and not actually getting one, right? That's at some point it'll be like, all right, guys, maybe we should review your systems.
well, maybe like because we always tell them, hey, as soon as we have an accepted offer, we'll get either POF like 24 or 48 hours, whatever, something like that.
Yeah. It's telling them you'll get it over to them in a day or two is fine. But I'd like to get a verbal acceptance first. Like, let's get there, right?
Yeah.
Make it easier.
Well, it just saves everybody's time, you know.
Correct. The reality is that a proof of funds isn't worth the paper it's written on. It doesn't exist. There's no such thing. The only proof of funds that is, I would say, even sort of good would be a direct bank statement that shows an amount of money. But even that's a joke because nothing's stopping you from spending it on anything else, like anytime you want. So the whole thing is a joke. In theory, you're showing capacity to buy, but even that, it's not that good. More experienced agents won't harp on it too bad if you can get it to them within a day or two, and you start opening escrow and that kind of thing. More important than that, please write this down for all of you. Your EMD goes to your title company in escrow within 24 hours. Do not screw with this.
Yeah.
Okay? Do not screw with this. If they accept the offer, you sign the contract, send that EMD over. Here's what EMD does. It limits exposure. We just talked about exposure a minute ago. Your exposure on a real estate contract is unlimited without EMD. Meaning, let's say you were going to buy a house off of me for 50,000 bucks. We agreed on a price. You send over a contract. I sign it. You sign it. You're supposed to do $1,000 EMD or $500. Nice small number. $500 EMD on this house. You don't put that in. A week or two later, you want to get out of the contract. You fail to close. I find out there's no EMD for me to get. It was never put in the way it was supposed to. I call up a lawyer and we sue you for damages caused. The damage is that I was now off market for a period of time because of you. It's caused me irreparable financial harm, not to mention it hurt my hair. I used to have a beautiful head of hair, and now I'm badly damaged. I need 3 therapists to take care of this. So I want $5 million. And you have full exposure on a lawsuit like that. Now, am I likely to actually get that much? No. But am I likely to get a big ass check? Yeah, I am. It probably will work out. And even if you had to defend against it, it'll be horrible. Otherwise, the EMD says that the damages on this contract are limited to this EMD. And that's it. So you can take the $500 and you can go away. And there is nothing you or an entire party of attorneys can do about it. So don't screw with your EMD. That is a protective anti-risk mechanism. It needs to be there. Also, since I'm talking to a group of investors, remember I am an investor, and deep down in my heart of hearts, I am extremely cheap when it comes to buying properties. I don't want to spend a lot on EMD You guys need to put in 1% of the purchase price, or at least $1,000 in almost every state in the country for it to be considered equitable and fair. So if you're trying to be cheap, I've seen wholesale contracts that make it $1. No judge in the world would accept that. They'll throw it out in a heartbeat. You really, really need to have that be about $1,000, pretty much everywhere. Okay. Yeah, bigger amounts are great. If you know you're going to close, it is a great strategy. Tim's mentioning that now. It is a good strategy to throw in a large escrow deposit. If you got it, throw it in. I'll put down 20K. What do I care? If I know I'm going to close, it's fine. Just make sure you're good to go after that. I see a couple of messages in chat about different websites you can go to get POF. That is true. They are more worthless than the other ones. You can also create yourself a PDF of one and just change the amounts as you go. Equally worthless. Be careful. This is your reputation. What we end up giving is a detailed quote that we are willing to back up with the actual financing. So it takes a little bit more work to get, but it actually has some degree of value. So yes, you can just print out stuff online and you might get an agent stupid enough to take it, but if they show it to their broker, who is probably not a moron, that's going to hurt your reputation. There's a lot of people who do that stuff. So be careful when you're doing this. We need to make a lot of offers, and we really need our reputation with the people who have properties, be they agents, wholesalers, or whoever, to stay as pristine as we possibly can keep it.
These are all about fix and flips. Do you ever lend for like buy and holds for rentals?
That's the majority of our business.
That is, okay.
Mm-hmm.
So you do lend for that. Okay, great.
Yep. I will actually move on to rentals now if there's no more questions about it.
Yeah.
About fix and flip stuff.
Can I make a comment with to Sophia with real estate agents? I actually have my real estate license in the state of Oregon, but it's inactive right now. I just put it on inactive because I don't really need it. And it's a waste of money. But anyway, real estate agents can get fined and they can get their licenses suspended if they don't put that EMD in on time. So that's something that's really, really important. That's like one of the first things when someone accepts an offer, you got to make sure that goes to the title company.
Yeah,
So,
and generally as investors, first we want to pick the title company.
Right.
If you want to write down the title company, you should all be picking. I do not get paid to say this. This is simply the right answer. You want to use BCHH Title. They are one of the only title companies that does all 50 states. If you have bought a house as an investor, you've probably seen that name before. This is who you use. In fact, you're going to use them whether you like it or not, because again, when you get title insurance, it comes from Stewart, and that's Stewart. It's not really the buyer who chooses the title company. It really is the lender. If we force the issue, we get our way every time. Most of the time, we're okay with different title companies. But I had twice last year where my mortgages didn't get recorded. They just failed. If they don't do good title work, you can end up in major trouble. We can get into like people going to jail mortgage fraud territory. So this stuff has to be done well. It prevents fraud. It keeps us all safe. If we're using BCHH, you guys can pretty much be positive you're going to be okay. And they're big enough that if they ever screw up one of your deals, they can afford to stroke a check to make it go away. Using, your mom and pop lawyer or whoever, they probably can't or won't do that. Stewart Title is not going to risk their reputation on our couple $100,000 or a couple $1 million deal. We don't matter. So I am very, very happy to be a very tiny, tiny speck in their world. They do excellent, excellent work in all 50 states, and they are based right here in Pittsburgh is their original location. So I am a huge fan. I could not recommend them enough, and no, they do not pay me to say that. But if you're closing, so that's who I wire our escrow money to. They get it. I also am then damn sure they're not going to screw with me when it comes time to get it back if the deal falls through. It's all going to work right. Like in Pennsylvania, there's a law that the buyer of the property gets to choose who the title company is. So when I started buying larger portfolios, we went to some credit unions to fund them. And they said, hey, we'll totally give you guys a loan, and you can use anybody else you want for title as long as it's this guy. And they gave us their contact info, and if we didn't use them, we would not have been considered for financing. So at the end of the day, I promise your lawyer can, or your lender gets to decide. You're going to do what they say. So BCHH is an awesome, awesome choice.
I have a question. I have an agent who wants me to sign this BRBC agreement. I can't read the agreement because it just says either accept or decline, but I've not come across this before. I'm new. Is that something it's important for me to sign? Is that normal for an agent and a broker to?
To have you sign a thing that says they get paid on that deal, whatever they call that version of a contract in that state, that's okay. I want the big thing I have about those is I want to see the address of the subject property on it.
Okay, yeah, I haven't even done that. I'm just working with her and she's like, sign this for me.
Yeah. Okay, so if you're just working with an agent, most agents, and 99% of agents give the other 1% a really bad name. Most agents don't have a clue how to do our business. And so the way that they're educated by their brokers is to treat you as if you were trying to buy a owner occupancy house to live in, which means you sign an exclusive agreement with them that says that any house you buy in the next period of time, they get paid a commission on. And then they will put you on a search on their MLS and you'll start getting emails for houses. As investors, this doesn't really work for us. Because if you go buy, let's say a wholesaler calls you up with a great deal and you decide to buy it, if you signed that contract, you would need to pay that agent's commission on that transaction. Mm. So I keep mine exclusive to a subject property. Okay. That is how we deal with those. So there is no blanket representation agreement. I have seen blanket representation agreements that can be terminated at will. That would be okay. Okay. So as long as the contract is basically useless, you can sign it. Otherwise, just be careful you don't get looped into anything you buy in the next 6 months. You have to pay this person.
Yeah. Thank you.
That's all. Mm-hmm.
So I have a question with the title company and TC, right? Transactional coordinator. When is a good time to use a TC if you're using a title company, or do we need a like TC at all if the title company is taking care of everything?
Title company does the majority in that. In fact, that's usually a position at a title company that handles the vast majority of that. So between your lender and the title company, 99% of the work is getting done. So there's very little for you to do. That position is something that if you scale your business enough, and you're doing a lot of transactions, like 10 plus a month, then there may be enough that falls on your plate that it makes sense to have something like that in-house. But otherwise, that's definitely, let title handle it. That's a closing cost.
Okay, thank you so much.
Mm-hmm. Sure thing.
Brian, I am curious if you ever do individual consults, because I have a deal that I am PMP in, and I started out as a second lien. I went in to help the person adjust the deal. So I put more money in that I was supposed to get back in 30 days, that they moved to they moved to the second position. Sorry, they moved that to the second lien position, of which later I found out they never actually recorded the second lien position. To then, I, at the same time, was trying to get them to get me like a JV or some sort of agreement. And when I did the agreement situation, they then did give me the agreement to the JV. But in the challenge of the situation, the new person that I brought in to replace me, because it was getting to be $550,000, the person that I brought in to replace me on the several properties that were being built, when the person came in to be the lender, they said that I was a PMP on the deal. and they wanted me to be a transaction lender, and I said no. I said that I've done more than enough and that I wanted to be considered in some position because I had different papers saying different things to get my money back. And so I was just curious from your standpoint on PMPs, is there any specific thing that needs to happen for that? And I'm also curious in regards to, they have all been legit people and they all have reputation, which is why I'm not saying who they are.
Yep.
But I could use all the information I have to highly impact all of them in a very negative way, but that's not who
Yep.
I am. And I don't
Mhm.
want to change who I am for how this is being done.
Yep.
So I'm just curious, like how, like if you are in a situation like this with a PMP situation, is there any specific advice that you would give regarding
How to deal with it,
presently
right?
making a positive move, like on a chessboard, presently making a positive move to make sure that your money comes back with actually some sort of return on it, but um not having to push an envelope in a way that would
Yep.
change who
Yeah,
you
yeah.
are as a person, because I don't want to change who I am as a person no matter how they're behaving.
Yep. So let me address that first. What we're doing as investors, this is a business. And so when we make an investment, we're looking for a return. If the terms of that return are not followed, if that's not being violated, us enforcing our agreement has nothing to do with our morality. That's business, right? To try to be a nice person, it's not about being nice or being mean. It's we set the rules and we have to follow them. And if we don't, that's how we end up broke. And so that doesn't work for anybody. So couple things on this. First, it's the whole an ounce of prevention is worth more than a pound of cure. It is far better and easier to structure this stuff correctly up front. And then a lot of these issues you're running into will never exist. Now, it doesn't mean that you have a irreparable problem, but it is far, far easier if we structure it differently. So, for example,
Just a thought in that whole structure piece, it was a coach. Because I say coach, I'm not necessarily saying who it was. It was a coach that brought me into this, that re-brought me into this.
Yep, I understand. So it wouldn't matter who it is. Grant Cardone could call me, and if he violated the deal, we'd be having a very hard conversation. So it doesn't matter who they are. And yes, you're right about the reputation being very important. So what happened, this would be the angle I took without knowing your specific paperwork or the particular deal. Big picture, what happens next is I'm going to need a show of good faith from the borrower, which means they're going to write me a check. I don't know how big of a check, how big can they afford to write? And it needs to happen now. And then when I get that check, I also expect shiny new paperwork that re-spells out our terms and makes it very clear. When am I getting paid back? What are the expectations? What are the costs incurred? This is where you start tagging in points. Like, yeah, I'm going to need 3 points just for this going on. That's going to buy you another 6 months, right? And then after that, you're going to be out of time and I'm going to need paid back. You're going to figure it out. So you can start getting into some harsher enforcement. The other thing that you're probably pretty close to doing is if the reception to that conversation is not extremely positive, as in they're taking your phone call without batting an eye and working with you on it, then the next thing is we're probably going to call an attorney next and let the attorney begin the process. The sooner, the better.
Okay, well, I really
Does that help?
appreciate that. I have been encouraged by other people to call an attorney, and I'm trying not to change who I am in the middle of who they are. So
It's
that's
not,
why,
it's not you, right? You have to defend your capital. You don't have a choice. You did not put that money out there as a charity.
Right.
It was supposed to come back with terms. Those terms have clearly been violated, or you wouldn't be talking like this, right? So it's
Right.
there's a problem. To solve the problem, you got to begin taking the steps. Step one, you better write me a check. Step two, we're going to update the paperwork. Step three, I need to see positive stuff or I'm calling the lawyer. Any pushback from them at all on any of this, you go to the lawyer immediately. And the lawyer begins the process because it's going to take a while. And so the sooner you start the ball rolling, the sooner they can hopefully claw back some of those funds, right? And then for all future dealings, let's help you structure them a little better. Let's avoid this kind of position ever again. It's just much better that way.
Thank you.
That help?
Yes. Thank you.
Mm-hmm. Sure thing. The other thing, another step that could be taken, if you want, you can just say, sign it over to me now.
Oh, I don't want it. I don't want it. I really,
Oh,
really,
I know,
really,
I
really,
know you
really
don't want it.
it.
Nobody wants it. But if they're not if they say yes to that, then they weren't going to finish it anyway.
No, I think they're going to finish it because there are powerhouses in this deal because I literally flipped the thing around and stuck powerhouses in it. And I can't speak of who the powerhouses are, but the moment I said the names, everyone on this call would know who it was. It was not JJ, but let me tell you, pretty close.
Yep, that's fine. But it doesn't matter. Again, it could be Donald Trump for all I care. It still has to be we got to see the deal moving forward. You know, this is our life savings. This is our wealth. This is what we do. We have to protect it. That is not making us the bad guys, ever.
Thank you. Thank you.
Sure thing. Let's talk about lending money for a minute. All right. First off, we are only making collateralized loans, collateralized business loans, which means I will never lend to an individual, and neither should you ever. If it isn't something LLC, there's a problem with your paperwork. Okay. Second, there is always, always, always a property or collateral of some sort. I mean, if you really want like a boat or something, you could do that too. But there is something there that is being put against this money. I'm not sending you a check for $100,000, $200,000 because you're nice and have a credit score. I'm sending this because there's an address with 4 walls, a roof, and an appraisal that says it's worth a hell of a lot more than I'm sending you. Okay. Second, when I say I'm sending you money, the reality is I'm never sending you a dime, ever. You don't get my money. Your title company gets my money at closing, usually the day of, maybe a day before. And then that money goes directly from me to the seller to fund the deal. You don't ever get to touch it. You couldn't take it and run off to Vegas with it if you wanted. It won't work. The money's never in your hands. For the construction, I'm doing a holdback. I keep that money. And I don't send it to you until individually you show me the work is done that made my collateral worth more. At no point are you holding my liquid cash. Does this make sense? In my case, I don't, because that moves my risk profile into absolutely unacceptable instantly. And I'm out. I don't have control. I don't have security. In the event that this deal goes south, how the hell do I access the collateral to sell it and get my money back? So unless I have a really, really clear, not fuzzy in the slightest answer of how this process is going to work, I'm out. We won't even have the conversation. Find somebody else, because that's how we get burned. Not that this fractional stuff is bad. It's just an absolutely horrid idea if you ever follow it through logically on a failed deal. We can do it either through a mortgage or through equity. In general, the mortgage should belong to the first position, which means the majority of the project. That is 50% or higher of total funding. All right. Even a non-recourse loan, about the worst terms you're going to get, should be about 50% of your cost. That is going to be the recorded first position lien on the property. When the property is bought, your title company should be delivering it with free title. No other liens, no other stuff going on. So All the money for the purchase goes in, wipes out any liens, wipes out any other mortgages. There is a clean, pristine, perfectly virgin title that then we stamp with our first position mortgage. And as far as the county and state of whatever that property is concerned, we are the only one with a claim on that property. In the event that that is violated, we will then follow the state's foreclosure process to take that shit back. And in the end of the day, that's just a question of how much and how long we will win every time. Okay, that's a first position lien. If we're not in first position because we're funding less, which, by the way, for almost everybody on this call, is what you should be doing. Firsts are not really something that is the best use of private capital. You can charge more to not be first, but you want to secure it with equity. That security is taking a percentage of the LLC that owns the subject property. Now, it doesn't matter what the percentage is. It's the part that everybody gets confused on. Why don't I take 40% or 50%? I am perfectly happy with 1. I couldn't care less. Because the other 99% is pledged against my loan. And if they screw up, I take 100% of the LLC. They are no longer owners of the anything. They're out and the property's mine. No foreclosure. I own it now. We still have the senior debt loan on it, but I'm now the owner and I can deal with them, either by refinancing them out, paying them off, or keeping them. It doesn't really matter how I choose to deal with it. But I instantly kick out the bad operator. None of this exposes my capital or prevents me from returning it. Guys, see how these structures work? All right, so the big thing, guys, is that we want collateral on our investment, and we want a super clear path to the what happens if the risk goes bad and the deal sucks and now I have to take it back. To quote somebody from the Atlanta Federal Reserve, we are looking for the dark cloud in every silver lining. When I assess one of these investments, I am doing so with the assumption that I have to take this property back. I don't want to. It'd be the worst day ever for me. Absolutely suck, and I'm almost certainly losing money. But if I can't make that scenario acceptable, I can't proceed. So if I have no idea, I'm a fractional investor, I'm one of like 7 other people getting in on this deal that's supposed to have these returns, that returns, whatever, and it goes south, well, okay, how am I liquidating that collateral to be paid back? Who ends up in control? They could, in theory, show me paperwork that my attorney could approve that says this will work, and I might be okay with it. But if it, I need a PhD or a law degree to figure out how the hell this works, that's probably too complicated for my money. There's much more straightforward deals. I am either first position or I am equity. I can write it in crayon on a napkin and still understand how it works. Makes life a lot easier. Does this make sense to everybody? That's simple business collateralization of property. For you guys as investors, you want the fewest number of chefs in the kitchen as you can possibly get. Every one you add increases the chances of something going south. Every single one. We have a chart. I'll have this in the equity group. I'll also be dealing with it at the Dealmaker Bootcamp for you guys. We broke down the complexity of a transaction based on how you're funding it. And so the easiest deal in the entire world is a cash deal. You're buying something for $100,000. You got a checking account with 120 in it. You show up to closing. You write your certified check. You hand it over, sign a couple of papers, and you are the proud new owner of whatever you just bought. That is the world's easiest deal. The chances of it failing are infinitesimal. Only a title issue would prevent a cash deal from working. Highest percentage chance of success, least issues that ever come up. Second easiest deal you could ever do is you have a partner who has enough money in their account, and they show up to the closing and write the check for the whole damn thing. It's the exact same thing, it's just not your name on the check. So that works too. That's the second easiest. The third is the most common in the world. This is the one that makes up almost every transaction there is. There is a first position lender, be that a bank, an institution, or another person, and they don't fund the whole deal, they fund some of it, usually 50 to 80%. And then the subject investor, the buyer, puts in their own cash for the difference, the down payment or the equity. All right. And so that's the most common transaction in the world. That's the easiest one to deal with. Okay, those three have almost no chance of failure, and they're super straightforward to both do, and once you own them, it's super straightforward for how they function. Let's flip all the way down. I have about 10, maybe 15 different kinds, and I will give you the most complicated one. This is the highest chance of going south for every single person involved. That's senior debt plus syndicated or fractional equity and no equity from the general partner. Oftentimes when I see this, not only does the general partner have no money in the deal, but they are paid at closing. Usually a couple $100,000. This would be your standard multifamily syndication. If this goes bad, it's going to go really, really bad. The people who have invested in that syndication are going to get hurt. It is super easy for that general partner to walk away. They just structured a deal buying a 400 unit complex somewhere. They get let's say it's $100 million. They get a loan from a big bank somewhere, or a HUD loan, maybe they even assume one, for probably about 60 mil. And then they got to raise $40 million. And so they sit down and they go out and they tell everybody how much cash they're going to make, and they have their lawyers write up all the paperwork, and they raise $40 million, probably primarily out of people's retirement accounts. And they likely did it by promising you returns in the low double digits, something in the probably 18 to 26% is what we typically see. And they take in all these investors. Since the average investor has $100,000, they probably have about 400 investors in that syndication. If this thing goes south, those 400 people are almost certainly getting wiped out completely. And the bank will take back the property without batting an eye. At that closing, the general partner is going to take a very reasonable 1% fee for putting together the deal. So that's only $1 million in cash at closing day. And they're going to keep equity in it if it goes well. But if it starts going wrong, do you think they have a problem walking away? It's a non-recourse loan. They can't be gone after. It only hurts the reputation with those investors, and they'll get different ones before too long. That's how this stuff really goes. And so as investors, we want to have an extremely clear risk profile. How am I getting paid when this goes bad? How is my money protected? Otherwise, you guys might as well just do the stock market, because that's the same thing, right? The real estate as a legal term, real actually exists, estate, asset of value. The advantage is that we can encumber that collateral so that our losses are not complete. Even if we lose money, the chances of us losing all of it are really low. We want to limit that. As a investor or lender, I want to know how I access the collateral to prevent the loss or limit my loss. And guys, this should be really straightforward. If you can't figure out how you get paid if the deal went bad, don't do the deal.
I wanted to ask you, are you funding 80% of the deal? How much do you fund on any particular deal? And wouldn't I get a PML to finish the rest? I know you were just kind of talking about that.
Yep.
Could you just elaborate a little bit on how much you would actually
Sure.
lend on a particular deal?
Yep. It's not nearly as straightforward of a question as you want it to be, but let me take a quick bat at it. First, there are two stages of residential property, and then there's commercial. So a 1 to 4 unit property is considered a single family asset, and a 5 or more is considered a multifamily. And then you have commercial buildings like stores and stuff like that. And then there's land. So all different categories all get different LTVs. For single family houses, on a new purchase, you can get up to 80% of appraised value fairly easily. On a rehab, that's 75. On a cash out refi, that also caps at 75. For your rentals, again, it's 75 to 80. You can get up there. You get the best financing dollar per dollar on single family stuff. There is no comparison. As soon as you cross into multifamily, the deal gets worse. Now the top you're likely to see is probably 75, though it's 60 to 75 is what we see. The on land, it's usually 50%. And I don't actually fund land. I have a couple of capital partners who will do certain types of land, but it's different stuff. Ground up construction is 65%. And that can vary. It can be 60 depending on your experience as well. 60, 65 is what you'll get. So that's
now,
go ahead.
Okay. What type of year do you go back as far? I mean, is there a build year like 1960 or 70 with a lead and all that kind of stuff in the homes? How far back do you go?
We don't care. That's just part of the appraisal. That's only what the house is worth. And it's part of your scope of work. If you need to make the place habitable so you can sell it. So if you have to remediate lead or asbestos or something like that, that needs to be part of your scope of work.
Actually, what I was asking, my question was, how far do you go back on land? So you're telling me it doesn't really matter as long as the numbers work?
With land?
No, with any particular property, home, 3-bedroom, 2-bath home.
Oh, yeah. No. The age of the property is irrelevant. If that's what you're asking.
And the age of the home itself is irrelevant too?
It's just part of its valuation. Yeah, most of the. I'm in Pittsburgh. The house I live in is 115 years old.
Oh, wow. Okay.
And the construction is way better than anything we do today. So, yeah, it's great. I have an actual 2x4. It's really 2x4. Replacing it's a pain in the ass.
I was always thinking about that metal, the conduit, so far as ductile pipes and stuff for plumbing. That can be very expensive.
Yep, it all needs ripped out and replaced. They can be very, very expensive rehabs, but that's a big part of what we do, right? So no, the age of the property is not super relevant. It's just part of the scope of work. I have had very uncomfortable deals where I'm losing money and I do not have enough to pay back the lender. I've had it. Okay. It absolutely sucks to make the phone call, and you better make it as soon as you find out. Every minute you wait will make it worse. And when you talk to them, you're going to find out the people are just really grateful that you have open line of communication. You're going to work out a deal. I've lost a lot of money in my career. Luckily, I've made a bit more, but I've lost a lot. And my lenders have never lost. That doesn't mean they got paid back on HUD, but I made them whole. I think the longest it ever took me was 2 years. But we paid principal plus interest to absolutely everybody ever. And we stay in communication with them. So as a borrower, don't ghost your lender ever. Call them, tell them what's going on, right? If they tell you they want the property back, sign everything they ask you to and give it to them. No fighting. Don't call a lawyer. Don't whine about the cash that you're losing in the deal. Give it back. You're done. Right? Don't even think about that. Because if somebody ghosts me, now I know that I really need to go to a lawyer. It's time. That's when this stuff gets ugly. If we structure it right, the chances of you having to go that far are infinitesimal. Again, 0.7%. That's the foreclosure rate. Amount of time that it's a little higher for, not making money, but actually losing money, less than 1%. We'll get the property back. We'll get our principal back. We'll get the thing liquidated. We'll get the job done every time. An incompleted project hurts everybody. We got to get them done somehow. These projects got to be finished. Structure the stuff so that it makes sense. Assume that the deal's going bad. You could have the world's best rehabber. I promise the world's best rehabber has seen rehabs go south and lost money. Promise. In fact, if somebody tells me their experience, one of the first things I ask them is, tell me about a deal you lost money on. And if they can't tell me one damn good story that is not made up, then I know they're full of shit. We lose money on some of these deals. It happens. We have to be secured accordingly. We took risk to get a reward. That's fine. That's the name of our game. We don't have to ever get mad about it. We knew the risk existed when we started. We want to mitigate and control that risk through knowing, that's experience, and through good structure that limits our exposure in the event of a fail. Okay? And you guys are talking about your deals. The problem that I come to very first when you're talking about being exposed on these deals and these loans not working out is that your structure is very poor. You don't have a clean way to execute and just take back the property. You don't have a mechanism to allow you to do that. So I'm not saying it's super bad. We have lawyers and things like that, and you can do that, but litigation takes time and money. We don't want to go there if we don't have to. My paperwork needs to be so good that if I ever go to court, I just win. You could hire OJ's team and you'll still lose in a legal battle with me because my paperwork was so good. And because it's so good, they know they're going to lose. They should never fight you. They should just give you what you need. That's how we need to structure these things from day one. You know, if you guys come to me to learn something, I have zero business trying to take advantage of you. At very least, I should tell you, here's some paperwork, take it to your attorney, get your attorney to sign off on this. And if you still think it's a good idea, here's a disclosure. It says this has nothing to do with the education we're involved in. You're a fully informed adult who knows what the hell you're doing, and we can go do this thing. That is the bare minimum that should be in place if you have a mentor type dynamic. So in rehabs, our big problem is contractors, right? It's the equity improvement side. In rentals, our biggest problem is management. Property managers. When you are looking for rental property, here's the order at which I recommend you do so. First, take a look at the state you're interested in, bring up their landlord-tenant laws, and if on paper you can't take possession back for non-payment in under 90 days, do not invest in that state, period. I have just disqualified pretty much every blue state. You're out, okay? Now, I'm sure there are some folks who like love investing in California and everything. Hey, good for you. Awesome. That is an unacceptable risk profile to me. The idea that somebody gets into my property, decides to stop paying me, and can stay there stealing housing off of me while I'm forced to pay mortgage, holding costs, repairs, utilities, potential insurance liability, and everything else for the next 2 years is a little past my ability to underwrite for. That's a little rough. Can't do it. I don't know how the hell you afford it. If you figure it out, please teach me. I'd love to learn. This also disqualifies New York, New Jersey, Delaware. Oregon is one of the worst states in the country. Though I'll give you a surprising one. The single worst place in the country for rental property is Cook County, Chicago. That is by far the worst landlord-tenant rules there are at a local level. Pennsylvania is pretty good, except Philly, which is actually a suburb of Camden, New Jersey. They have enough local landlord-tenant laws to make that absolutely horrible as well. I am very happy in Pittsburgh, though the city of Pittsburgh itself could be better. Your Sun Belt is usually okay-ish. So your Floridas, Georgias, Texas. Georgia minus Atlanta. Atlanta's pretty bad. They passed some local shit that is a problem. Your Texas is well known to be one of the best across the board. Their eviction is you're out in a week or you get shot. So that's kind of cool. Arizona and New Mexico are a mixed bag. So you'll need to take a look at those specifically for your what cities you're in. You can get some local ordinances that are a problem as well. But rule one, if they stop paying you, the legal system better let you take back your property. And if that is not the rule of the game you are playing in, then at least from my personal investment profile, I'm out. I will not invest in that state. I'll lend to you on it, but when they don't pay you, I expect my mortgage paid. Okay? All right, so that's thing one. Thing two, does the market allow cash flow? Let me give you a really simple example. In the great state of California, there's a little town called San Diego. It's kind of pretty most of the year. It doesn't have weather, it has climate. And the median price of a home there is $650,000. The median rent there is $2,200. That's a 2 cap. That means it will take you 50 years to recover your capital in that investment and become profitable. I don't know about you guys, but 50 years is a bit longer of an investment horizon than I'm interested in. Remember, we talked about time risk earlier? 50 years, bit rough for me. I'm more of a 5 to 10 year guy myself on my buy and holds. I like that number. It makes me a bit happier, right? So I've heard this called the 1% rule, which is not exactly mathematically accurate, so it messes with my head. But a basic way to do it is that whatever the rent is in the area, the property is worth about 100 times that. That's a 6 cap. Okay, so if it rents for $1,000, then it's worth $100,000 to me as an investor. If I am in a town where it rents for $1,000 and the median price for the thing is $350, that math doesn't work, does it? So we need to go to a place where cash flow is viable, or you're going to need a very special snowflake of a property for it to work. Does this make sense, guys? Rule one, do the state laws are they business friendly enough that I can enforce my property rights? Rule two, does the market let me buy the damn thing at a price that actually cash flows? Third, can I get phenomenal property management there? All right, my experience with property managers. This is a couple hundred units in a couple of years, including owning and dissolving our own management company. Property management may be the single worst business I've ever been involved in my life. It makes no money, it is absolutely miserable, and everybody involved in it hates you. There are some lovely people out there suffering from a mental illness who actually enjoy it. Find them. In almost every state, they are required to be real estate brokers. So they will be a functioning, legal, licensed, insured brokerage. I do not recommend messing around with, they call them co-ops, where there's you can add them as like 1% to your LLC because it's legal to manage your own property. So if they're on the LLC, they get to do it. If they don't have a broker's license, that's a bit too shady for my multi-million-dollar investments. But you guys do you. I mean, get the damn license. It's not that hard. Management has to do 3 things really well. And if they mess up any of them, it's going to cost you a lot of money. Number 1, leasing. They need to be able to find and place tenants who are qualified, who pay, and who take care of the property. And if I have to choose between a tenant who pays and a tenant who takes care of my property, I'll take one who takes care of the property every time. A tenant who pays your rent and causes $50,000 in damage in 3 days from being there is not something we can underwrite to. That is beyond scope. So they better have a system in place to identify qualified tenants, put them in place quickly and reasonably. Second, maintenance. They have to be really good at turning the units. And they have to do so at a price tag that is investor reasonable. That usually means slightly more expensive than a rehabber would pay to do the same thing, like if you ran the project yourself. But it's sure as hell not retail. They don't call Roto-Rooter to fix your clogged toilet at $500 a round, right? They better have a plumber on task. They also should understand rental grade quite well. There is a very fine line in rentals between replace and repair. If you are dealing with a retail listing agent, their default mode, because they're used to selling house to owner occupants, it's going to be their dream home for the next 30 years. All right, my tenant doesn't give a shit. They might be there for 24 months. It's fine. Their mode is if anything is even slightly wrong, replace it with new. We're going to do repairs where possible and replace where it makes sense. That is a fine balance. There is not a universal answer. It depends on the asset class. If I have a luxury grade apartment or a duplex in a class A neighborhood, that might as well be a retail rehab. You're going to put luxury stuff in there. If I'm doing a Section 8 thing in a Class C neighborhood, then paint over the roaches and make sure it passes inspection. That is the standard for that asset. The manager needs to understand how to maintain that asset class. Somebody who's really good at multifamily may not know the first thing about maintaining a single family portfolio, and vice versa. The zip codes matter. The Class A broker has no clue how to do the Class C stuff, and vice versa. So make sure your manager can handle the specific assets that you were investing in. Once you've done all of that and you are 100% sure you got that right, I know who my manager is, I know where I'm investing, and I know the price tags that I can expect to be paying for it. Then and only then should you consider going shopping for your buy and holds. In which case, you can just buy the shit off the MLS. You don't need much more help than that. Go to town. Rinse and repeat until you have a couple hundred. Have fun. Any questions on that little rant? Maybe you can tell that I've done a little bit of this. Are rentals a good value? They are an amazing value, and the odds of you being taught what they actually are close to zero. When I buy a rental asset, it's on a 5-year initial timeline. Years 1 and 2 are successful if I don't have to write another check to the project. So I buy it, and whatever I thought I was going to spend on it, even if I need to put a new bathroom in for 10 grand or something, that's fine. I just put it in there. If over the next 2 years I don't have to make an owner contribution to that property, then I did good. I win. This has nothing to do with making money, and on the majority of those properties, you probably will not. Years 3 and 4, I want to make more money than I underwrote on my magic spreadsheet that told me how many billions I was going to make on it. I want to make more than that in year 3 and 4. So if I thought I was going to make $200 a month when I bought the thing and I just didn't lose any money for the first 2 years, yay, I win the game. If I make $201 in year 3 and 4, I'm still winning the game. We are very happy. Year 5, I refinance. Then and only then will I begin counting that capital towards my passive income. How passive a rental property is make or break on the management. If the management is good, you have very little to do. It's easy day. If the management is not good, then it is about 50 times more work than even being a rehabber. Because you can't get anything done yourself. You have to call a bunch of other people to do it. And you have to work around tenants and their schedule and their needs and my rights and all that other nonsense. So can be a pain in the ass. Now, as far as wealth goes, buy and hold beats everything else in the game without even having any, there's nothing else even close. In lending, we have one stream of income, whatever the hell our interest is, and that's a capital gain. So we get smacked on that, right? Beautiful thing, extremely passive. Obviously, I wouldn't be doing a lot of it if I didn't think it was amazing, and we should be doing that. Rehabs, biggest checks in the game. You just get giant checks, tens and tens of thousands of dollars. Those are income, people. So enjoy your newly close relationship with the IRS. Bring WD-40. Rentals give us all the benefits. In fact, the IRS has a tax designation for real estate investor. Everybody who calls themselves a real estate investor is only a real estate investor if they buy and hold real estate for greater than 12 months. It is a tax designation. So if you call yourself an investor and you've never actually held a piece of property for at least 13 months, you don't match the designation. So a real estate investor is actually somebody who holds property. The tax advantages we get are stupid. We have the biggest tax advantages in the entire US tax code by far. You can access only after holding property for greater than a tax year. Can't even touch it till then. The long-term appreciation on these things outperforms the stock market. The cash flow gradually increases. When you buy at a cap rate, unless you refinance and change the debt structure underneath it, your rent increase is going to go up higher and faster than your expenses. Your cap rate increases. If I buy at a 6, 5 years later, I may very well be at an 8. If I buy at an 8, 5 years later, I might be at an 11. After 30 years, if I didn't refinance, I own the damn thing free and clear, which, by the way, I do not recommend ever doing. Separate class. Don't do that. But your cash flow will increase every single year. Your equity increases every single year. Your tax benefits continue on into perpetuity. They're the best ones run out in 27 and a half years, at least on single family, 40 years in commercial. So you have 5 streams of income with your buy and holds, and most of them will give an IRR, at least the way I underwrite them. I'll only buy one that gives me an IRR adjusted to about 20% a year in the first 5 years. But it's slow money. It's not fast money. You do not buy these things like, oh yeah, my base cost is only $1,000 a month and I get to rent it out for $2,000 a month. You are smoking crack. That's not how this works. Even if that's the way your math worked, you're going to end up doing repairs to that property. You're going to end up with a vacancy. You're going to end up with an involuntary eviction. You're going to end up with a moron manager you got to swap out. And that $1,000 a month is going to evaporate, and it's going to evaporate really fast. In the first 2 years, you're going to learn about most of these problems. And these problems are per property. If I buy 100 single family houses in the same zip code with the same manager, there's going to be a lemon in there. It's the house. All the other variables could be fine. I bought a bad one. And so after 2 years, if it's not performing right, I sell it. I don't care. From both a financing and management point of view, single family outperforms multifamily dollar per dollar every day, all day, across the entire country, period, no arguments. Anybody who tells you otherwise is trying to sell multifamily. This is not to say that multifamilies are not a deal. They can be. You simply need a better deal than you would in a single family to get the same outcome. Okay? You guys can write this down. So I have 3 rules of investing. Rule number 1, it's more important to not lose than it is to win. Kind of what we've talked about so far today. Some of the best deals you will ever do in this business are the ones you say no to. It can take you years to recover from a bad one. So unless you're pretty confident it's going to work out, don't play. It's okay. There'll be another opportunity. Opportunities are not limited. There's always more. Rule number 2, whoever writes the biggest check writes the rules and takes liability for the underwriting. If I'm going to write 80% of your deal off on my books, guess who I'm going to blame if the underwriting's bad? My problem, right? If you choose to privately fund a deal for someone or pay cash for it, guess who's responsible for the losses? Okay. A really good question if you are a investor, borrower, operator. Really good question to ask yourself. If this was my life savings funding this deal, would I do it? If the answer is no, don't do it. What the hell are you borrowing somebody's retirement account to get this thing done for? Right? You talk about being ethical? What's more unethical than borrowing your grandma's money to lose it? Seriously. Use your powers for good. Don't be an asshole. And rule number 3, the market dictates your returns, and those are adjusted for risk and experience. Returns outside of that scope are a massive red flag. Guys, a 30% cash on cash return is borderline fraud. That's not what real estate pays. In most cash flow markets in the United States, a Class B rental, single family, is a 6 to 8 cap, turnkey. 6 to 8. The same thing, same zip code in multifamily is 4 to 6. When the wholesaler offers you the 12 cap, that's a red flag. The market don't give these. This tells me one of 2 things, maybe both. First, the property is in god-awful condition, and we're going to have to pay enough money to fix it so that by the time I'm done with that investment, it's a 6 to 8 cap. Or it's actually in a shit area, and you probably don't want it. That's not a Class B area, that's a Class D area. It's also possible the property is really weird. Don't buy weird properties. In a neighborhood where everything's a 3-bed, 2-bath, do not be the guy who buys the 1-bed, 650 square foot place with a detached garage. Don't do it. Weird doesn't get us paid. Weird puts us at extreme risk.
What qualifies an apartment building as a shit area? I live in Los Angeles County.
Being in California would be a good start, but no, serious.
But I wrote
though,
that. Thank you.
Yeah. Well, I mean, not to be political. It's more about policy. The policies are tenant friendly. You can't evict. The challenge that this is a commercial appraisal term. They're not allowed for political reasons to call someplace a ghetto. You're not allowed to say that. They don't like that. So in commercial appraisals, they will actually qualify neighborhoods as A, B, C, or D.
Okay.
And so that is actually a full designation. I'm not making that up. What we generally mean, though, and you can sort of figure this out yourself anywhere in the country, is a Class A would be a upper income, upper class type area. Class B is upper middle class. Class C is lower middle class to lower income. And Class D is extreme low income, poverty, hellhole. And Class E is usually a industrial area, no residential at all.
Yeah.
Okay, so that's kind of your breakdown of that stuff. As investors, both the high end are Class A and the low end are C, D stuff, C minus to D, are specialties.
Okay.
You need special systems. You need different managers. You need different expertise. You need to know this stuff. If you're going to do luxury houses in Glendale or something, then you need to have contractors who can handle that stuff. You need agents that know that market. You need financing that can buy your $5 million houses and all that. You need all that stuff in place. And the way you will do those projects is very, very different than if I was doing them in, let's say, Baton Rouge, Louisiana, or Detroit, Michigan. The values are different. The expected construction is different. Same thing with the rental property. If I am doing a Class A rental, these are really nice. The tenants who can afford them have a ton of options. You're talking about a doctor who doesn't have a problem writing a $5,000 a month rental check. He couldn't care less. But he can pick from any $5,000 rental in the city. And if you screw with him even in the slightest bit, they'll just leave. They don't care.
Sure.
You want to enforce the rest of the lease and make them pay the rest of the year? They probably still don't care. That's an extra shift at the hospital or something. So to be able to keep the clientele happy is a specialty, and to maintain that, right? My rentals are B and C. I do middle class stuff all day long. I don't mind Section 8. I do that kind of stuff. I know how that works. I'm very comfortable with it. The returns on that are the best balance between risk and reward for me. I'm pretty happy with that. You can do very well in affordable housing and low income stuff. I don't specialize in it. We don't mind it, but I don't try. And I stay away from luxury stuff because in a economic downturn, everybody in a Class A area moves to the Class B areas.
Okay.
And the Class A people get eaten alive. Yep, go ahead.
Thank you very much on that. So I always dreamt of buying, a 4-unit building, live in one, and rent the other 3. It sounds like earlier, if I heard it right, you don't like that. Is that correct?
I would not finance that, no. To do a house hack, you would typically do a FHA loan, and you would go to a conventional mortgage lender to get that done. What I would strongly suggest you do to make it work, because it's a phenomenal thing, it's especially cool for young people. It's a great one. Do your damnedest to put 20% down so you do not have PMI.
Okay.
You do not want that PMI. And then it's some of the cheapest money you can get. So it's a great system. It really does work. It doesn't scale at all. Obviously, you can't live in multiple houses at once. You can only get a couple of those kinds of loans at a time. But after a couple of years, you go ahead and move out of that property, fully rent it out, refi it with a conventional DSCR loan, and then you can go play again. And that's how people basically in their 20s or newly divorced or that kind of thing, that's a great way for them to slowly build up a portfolio. It can be a good way to play.
Huh?
But no, I won't fund it though. If you're going to live there, I'm out. You can't be an owner occupant. And this is since we've been touching on lender stuff today, does anybody know why?
No, I don't.
It comes from the foreclosure. All the lending we do is considered commercial, which means there's no fight. I just win. I get the property back. We sell the property. If there's tenants in there, their leases are honored, but that's it. If there's an owner occupant, you have all the consumer protection laws in place. And in every state in the country, that can drag out foreclosures for years.
Wow.
Of course, all kinds of stuff. So the risk profile goes through the roof. So most of those loans are bank loans backed by Fannie Freddie. The federal government guarantees them. None of my loans are guaranteed by Fannie Freddie. If you guys don't pay me, I'm not getting bailed out by Uncle Sam. So for us as investors and you guys as private lenders, never, ever, ever, no owner occupant. If I ever found out somebody is living in there, it is an immediate full default. The money is due today. Get out. You got to refi me out of that property immediately. And we would do that the moment we found out about it. It's huge, huge risk to us. So can't allow it.
Brian, I got to tell you, you're a wealth of information. I'm new here. I'm just blown away with all the information. Good luck. Rapid fire.
Thank you.
Thank you. Thank you.
Yeah, of course.
So first question would be depreciation. So when we buy a house, don't we get the first 7 years up front for depreciation from the IRS for our tax purposes?
No.
Huh. Well, okay.
You get your depreciation schedule is the purchase price of your property divided by 27.5. And you get that once a year starting in month 13 of ownership.
Huh. All right. I was actually told from the man 7 years up front, but I guess you're saying no. Huh.
I mean, talk to a CPA in the subject state. Maybe there's something there I don't know about. Whatever. You can also do a thing called cost segregation, where you pay a third-party engineering and accounting firm to come into the property and produce a report. And that report, this is a shorthand way of saying it. This is what it does, not how it does it. It effectively changes the depreciation schedule from 27.5 years, usually to between 5 and 10. So now, instead of whatever you bought the property for divided by 27.5 each year, you would do it divided by 5, 6, 7, 8, 9, 10. So it would be a much, much larger number.
Oh, okay. I see.
Now,
my next question. Okay, go ahead.
So once we depreciate a property, when we sell a property, you have to pay capital gains tax. That tax is calculated. The exposure for that tax is whatever you bought the property for. So it's whatever you sell it for minus what you bought it for, minus the depreciation. So if we fully depreciate a property, it's 100% profit and 100% capital gain exposure. So if we're going to ever do something like a cost segregation where we're trying to extract those losses out of a property faster, that means that you would only ever keep the property until you die, or you would do a 1031 exchange, which is a way of kicking the can down the road. Depreciation, you can think of it as a 0% loan from the government that you only pay back if you're stupid. Okay.
Next question here, Brian, is what about RV parks? Do you know much about RV parks? Because I own some, and what about because I'm a landlord, and being in Alabama, it's a tenant-friendly state, and I'm experiencing that right now. You know, I've had my tenant was able to not pay rent for 4 months. You know, and it's crazy because they can push it out. They actually push the date out, and that's the court system did that. So because of that, she stayed there with her ex, and didn't have to pay rent. That's kind of what sucks. But how do you recommend getting paid? I mean, getting protected in a landlord or tenant friendly state?
So RV parks are interesting because it depends on what exactly you're renting out. If the subject property has wheels on it, that's not a house, that's a vehicle, and vehicles can be repossessed. So you would have to check with an attorney who knows your particular rules a lot better than I do, but you can repo it. You can take the whole damn vehicle. You would just need a court order to allow you to do it.
Huh.
There's other stuff too. I mean, you can get into it. You need a good real estate attorney who understands landlord tenant law in your subject state. There's some really interesting things you can get into, but kind of like lending, you're way better off just structuring it in such a way that this isn't a problem to begin with.
Yeah.
Because we don't want to deal with this stuff. But you can get into some crazy things. Just to give you guys an example, it's more of a food for thought thing than anything I would ever want to see any of you do. But if we get a judgment against someone for some amount of money, in many states you can seize property in order to compensate for those losses, that judgment. And house pets are considered property. If you take Fluffy, I wonder if they'll pay. I'm not recommending or endorsing that. I'm just saying get a good real estate attorney.
All right. Thank you.
That help?
I appreciate that.
Oh my goodness, man. Don't ever piss this guy off, man.
I'm really very nice. We're just talking about risk, and you guys are telling me about risks that went bad. So now we're on limiting damage, which, we get less nice.
Hey, I mean, like, they don't tell us all this at the real estate seminars. If they did, we probably wouldn't be even trying,
Yeah.
and we all got to learn from our lessons. But my goodness, like talking about Fluffy and management skills and contractors, you're just
I'll give you
right to my freaking heart, bro.
I'll give you another one. Okay. But this comes with a disclaimer. Everybody needs to nod their head that they acknowledge my disclaimer. I am not an attorney. I am not a CPA. I am not a tax professional. This is not advice. Yes? Okay. You will need a cooperative CPA to do this. Usually one that owns rental property and hates tenants is the way to go. When you are qualifying your tenants, as one of the things that you should do as part of your lease is you should get all the relevant information. In fact, include a W-9 in the event that you have a situation where a tenant ends up owing you a lot of money. Say they didn't pay a bunch of rent, they moved out, they caused tens of thousands of dollars in damage. Without ever going to court, what I go ahead and do is create an invoice for about 3 times whatever that number is. So if they did $30,000 in damage, I'll do a $90,000 invoice. I will go ahead and zero out that invoice and 1099 them for it. Now, with my $90,000 income loss, I will take the money that I had to pay them as a tax write-off, outsourcing the debt collection to the IRS, who are bound to be better at it than me. Again, not advice. I don't endorse this topic. It could be a terrible idea. I could be full of shit. End of rant. You do have to make enough money that you would owe that much in taxes, though.
Yeah, thanks for thanks for telling us that you're not a CPA, attorney, and all the other good stuff that
No.
doesn't. Yeah, my goodness.
Some stuff
I like the 1099, man.
some stuff we've gone through. So
Love the 1099.
I'm one of those that I don't like walk around the table. I'm straightforward. So as tell me, don't tell me, show me. And then I'm just one of those like what are my options? List them all, A and B, and as a yes or no questions. And who do I need to talk to? I'm and plus being in this thing, it works. Yeah, it works. But yeah, you definitely need to know your property management. And as for tenants, like, and your contractor.
Every house has a story.
Yeah, buy and hold would be, as a business, being a landlord would be amazing if it wasn't for the tenants.
Yeah.
So that would be really cool if we could eliminate them. If anybody figures out how, call me.
Yeah.
I want to know. But in general, that's not how it goes, right? So, but just like the lending, they parallel really well. The lending risk control and tenant management, property management is really similar. It's maintaining a relationship backed by extremely clear terms and an enforceable contract.
Yeah.
That's it.
Yeah.
And so no tenant in history has ever been evicted because they didn't pay their rent. It's never happened. They're evicted because they chose to make it the property owner's problem.
Mm-hmm.
If you lost your job, that sucks.
Yeah.
Call and let's come to some kind of terms.
Yeah.
When they just don't pay their rent and want to make it my problem, I have no choice but take legal action.
Yeah.
Recourse.
Like what you had said earlier, you know, I pay mortgage, I pay property tax, I pay property management and all the things. So, you know, if you're not able to pay the rent, then
Yep.
I have to pay for all those.
Get the hell out.
Exactly.
You know what I mean?
Exactly.
I have to pay all those and extra so you can stay in that house, you know? So, you know, you
Yep.
can't be in there for free, and that's pretty much.
Well, then we need grants.
Exactly.
We need the government to give us grants so we can sponsor them. You know, that would work.
And so that
Yeah,
all
and
comes,
yeah.
so it's
Good
so
idea,
it's,
buddy.
it's structure again. And so
Mhm.
this is why if we have good management who have a strong leasing team, leasing is really tenant relationship management. Yes, you do the background checks and everything else, but is the person you're putting in a scumbag? And that can be a relatively difficult thing to tell because somebody could be a perfectly upright citizen until they reach some degree of financial pressure, and then it's everybody else's fault but theirs, right? So if you got a great leasing agent, they're good at identifying that stuff and minimizing the chance you're going to have it. If you don't have any bad tenants, you clearly haven't bought enough rentals. They're part of the game. Just like eventually you're going to do a rehab that won't make you any money, and you're going to have to write a check so that you have the privilege of working for 9 months. That's some of what we do. Now, this all sounds really negative, and I heard a couple of you make the comment they don't say this stuff in the seminars. They don't say this stuff in the seminars because they want you to do the business. And the simple reality is, guys, we make a hell of a lot more than we lose. I've lost about $3.6 million in the last 15 years. Every dollar of it absolutely sucked. And most of it has led me to the conclusions and opinions and systems that I've shared with you today. Because I don't want to do that again. Sucked the first time, and I'm out. 3.6 million. I am not big enough to make or lose $1 billion. That's a bit past my scope. Sorry. Maybe someday before I retire. But we learn from this stuff, right? I've made a bit more than I've lost. That's worked out really well. And now we have what I think are really good, safe systems to do this in this business where we make reliable, good returns. Now that brings me again to that third rule. Can anybody tell me what it is? Did you write it down? What was rule 3?
Grades dictate your returns, risk, and experience.
Yeah.
Dictates returns.
Yeah, the market tells us our returns. On a rehab, you guys are going to net around 12%. You might do a little better. You might do a little worse. But you know what's not going to happen? You're not going to make 30%. That's weird. That's not what normally happens. When somebody is advertising some amazing new syndication or passive investment opportunity to you and promising you a 35% IRR, that's weird. The market doesn't do that. It's not the kind of returns we get. That's a big red flag that's going to have me reading a lot of fine print and having my attorney go over to it with a fine-tooth comb. And that's assuming I'm not just like, no, too much bullshit, can't be bothered. Go show me a deal at 12 to 18% instead, and I will be a very happy man. Because now I don't have to worry about it. It walks like a duck, quacks like a duck, probably a duck. We're good, right? So have normal expectations for this stuff, guys. Learn what those are for your area. It can vary a little bit, but they're not going to be crazy. You're not going to get these 30, 40, 50, 60, 100% returns without taking a commensurate risk. If you're comfortable with that risk, if that's your risk profile, please go with God. I hope it works out. You can lend to me when you're rich and feeling a little bit more conservative, right? That's fine. But don't get promised and I don't care who the people are. There is no status in real estate. There's the size of our bank accounts, but that's about it. That's the only status we really have. And experience. Experience would be shown in HUDs. So if you guys learn what normal is, stick with normal, structure this stuff so that you have security, and about 99% of the time, you're going to make pretty good money doing this game. And the 1% that doesn't work out, you're going to take a little haircut, but you won't necessarily get burned alive. And I think that ends my rant on risk.
Ryan, I got a question.
Mm-hmm.
Buying and investing in property, rental properties, is that a good investment?
Rentals? Yes, absolutely. Absolutely. Just be clear. They are long-term investments, 5 years or longer. Do not set an expectation that you are going to get to keep the cash flow in the first year or two. Even if you make money, it's very likely that something's going to come up, a vacancy, a repair, something that's going to eat that year or two worth of capital. So even if your bank account reflects that you made money, until month 24, I'm probably not going to consider myself to have made anything.
Okay.
Okay, that's my experience after I'm at 306 stores. So that's just how we see them.
Thank you.
There's a lot of guys a lot bigger than me, but this is just generally how we look at it. We found if we set our expectations very conservatively, we are rarely disappointed. Another thing I've noted, we've done post-mortem accounting on all of our rental properties. The properties that made me the most money in the time I've owned them have been the ones I paid the most for. They've been the worst deals on paper. And the ones that have cost me the most money have been the best deals on paper. Because what tends to happen with the overpaid ones, you're buying them up basically off the MLS. They're fully ready to go. You had to pay top dollar for them. Some tenant moves in and just stays there forever, and they're perfectly happy. And so, yeah, you didn't make as much initially because you have a lot of holding costs on them, but they stay there. The rent goes up every year, and gradually you just consistently make money without having to do any major repairs. On the other hand, when we buy these things cheap and we're going to fix them up and rent them, by the time we finish with the cost of the repairs, the holding costs for doing it, the refinancing cost, and all that other stuff, I end up at basically the same position, a 6 to 8 cap. And then I may or may not get a good tenant in there that changes it up. So for us, our experience has been the class C, class B, MLS, already good to go, doesn't need anything, pretty houses that I had to pay too damn much for were the best investments I've made. That's been my experience.
Brian, one more question.
Mm-hmm.
So is there such thing as an average of how long these tenants stay in your building?
Data will probably vary by location. In my case, single family tenants stay close to 3 years, and multifamily are 1 to 2.
Okay, thank you.
I mentioned before, but dollar per dollar, single family outperforms multifamily every single time. There are several reasons for that. The first reason is that multifamily has a greater expense ratio. We always have common areas, and we end up being responsible for landscaping and parking and that sort of thing. In addition, local governments love to go after landlords for tax money when they're broke, which is always. So we tend to see higher property taxes on multi than we do comparative singles. They just tend to be higher. So you're paying higher cost to hold them. Tenants tend to stay a little bit less. They don't stay as long. The quality of tenant, again, this is maybe more specific to my market than others. The quality of tenant we get in multi is lower. It's they just, the people who can afford it prefer to stay in a single family house. In a single family, we make the tenant responsible for all upkeep and utilities. In a multi, we can't. We have to cover some of those costs. So dollar per dollar, we have to spend more in expenses on those multis. The cost of the repairs, it's commercial construction, that tends to be higher as well. So just across the board, it is more to run a multifamily. That is reflected in your financing terms.
Amazing. I got to tell you, Brian, I'm brand new to this.
Mm-hmm.
I'm looking at it, it's like, is this market for me? I mean, again, I don't need a new job. I have a job that I love, but what do you do with your money? Yeah, this has been amazing. You asked a lot of questions I had. Thank you.
Thank you.
And God bless you for
that. Yeah, I appreciate that. I'm glad you guys find value in this stuff. It's hopefully my rather high cost of education can be passed on to you guys for a little less. So, but again, take a look at, if you guys reach out to JJ, talk to him about the equity investing group. That is, I have to say, I'm a little surprised by it. I thought it was something that I decided to do, but I got to say the interest from you guys is very pleasing. Where you're running a job you're happy with, you're making some money. You don't want to be a full-time rehabber. That's a job, man. You got to go run a construction project. There's stuff to do there. Same thing. You don't want to be a wholesaler, and unless you got property management down cold, you don't really want to manage tenants either. So being a limited partner, passive equity partner with a qualified operator can be a phenomenal idea. The returns can be very, very high, and it stays passive unless they screw it up, in which case you have to take it over and correct the problem. But it can be a phenomenal way to get some returns. And so if you join that group, I'm going to be doing training on that starting next week. We're going to show you guys how that all structures out and works, give you a bunch of different ways you can do it. We're going to take you through underwriting at the level we do it as a first position lender. You won't have to do that if you insist that they use a first position lender like me. You can just outsource it. But we'll teach it to you if you want to do it yourself. And then last, we're going to go over how do you pick the operator? How do we identify that rehabber or buy and hold investor who can handle this stuff so that this investment stays passive for you and gives you the returns you need? So we're going to share all that stuff with you. And I'm not charging you for it. I just expect you to use me for a loan because that's how I get paid. So
Absolutely.
Don't call somebody else. It's you call me and we'll get it. That's it. That's what we educate for.
Yes.
Okay. And then obviously, love to see you at our live event in LA. That is on June 20 and 21. First day is a live training with myself and my partners. I think you guys will really appreciate that. If you've liked spending a couple hours with me, wait until we're actively doing deals. That's a pretty powerful thing to do. You may end up with a deal in the room.
Wow.
So we're going to have you making offers right there. And then the next day is JJ's famous networking picnic. I think this is year 3 or 4 that he's doing this. And we get a couple hundred people there. You can do some amazing networking where you can meet future potential partners, find more deals, and generally grow your business. So want to see you guys there. And we charge an insane amount. The VIP ticket that gets you both days, I think, is $77 and includes lunch. So don't whine about the price. It's cheap, okay?
Lucky for me, I will be there on both days, and I talked to John. He's also on board. Where can you get a deal like this?
Yeah. I mean, we've been so I met JJ when I was a speaker and curriculum developer for another education company. I've coached a couple thousand people over the last couple of years, and during COVID, they kind of shut that down. And then Pace Morby Sub 2 has sort of replaced that as kind of the large community that's around in the country. So we've seen all this stuff, and I've seen the education space for years. There's nothing wrong with it. I'm here because of the education space. I went and sat in a 3-day thing, cut a check for $85,000 in 2011, and
Wow.
And it's been worth every penny. I wouldn't be here if I didn't do it. It was primarily useful as a networking tool and to get an additional idea of the systems I need. But they made their money from my tuition, which means they were incentivized to get me to buy more training. So when I partnered up with JJ and the others, and one of the things we talked about is, well, I want you to make money when I make money. So I'll educate you for free. I'll share everything there is to know. No problem. I get paid when you do a loan with me. You're only going to do a loan with me if you're doing a deal. You're only doing a deal if you know how to get one. I'm only going to fund it if you know how to underwrite it. And it's only going to work if you make money. And so that creates a mutually aligned income. At no point will we be to you guys, hey, I need $10,000, $20,000, $30,000. If we do a live event, this is probably the cheapest live event we will ever throw. I would normally try to do a 3-day for probably about $500 because I want to do it at a really nice hotel somewhere. I want an open bar. I want good food, and I want all of that covered, and I'm not buying your food. So I'd rather do something nicer, but that's the closest you're going to get us to just charging you for things. Otherwise, do a loan. I get paid when you do that. Part of the deal. So nice mutually aligned income. That's what I wanted to see you guys do. I don't want to hear about anybody making a loan that lost them a lot of money or anything like that, because that means you're not playing anymore. You're out and you'll never do business with me. We have aligned our interest with you guys as much as we possibly can. I remember the very first live event I ever went to after cutting that check, which it wasn't really a check. It was a credit card that I had no business putting this on. I remember sitting there. I was right in the front row, wide-eyed and excited. And all I wanted to do is learn the magic words that I would tell somebody to get me to sell their house at a discount so I could do the thing, right? I wanted the script. And the guy stood up there for, it was like a 6-hour long presentation. And the whole time he didn't tell me any of the words I wanted to hear. And all he kept telling everybody over and over again was, you need to fix your mindset. You need to have a growth mindset. You need to be positive. You need a good why. And I'm like, did I just pay tens of thousands of dollars for a fucking motivational seminar? Like, what is this? I was pissed. Fast forward ahead a decade, it would have been impossible for me to get where I am without doing that.
Yeah.
Absolutely impossible unless you become the kind of person who can do it. We have to be pragmatic optimists. Have to do it. We have to function on the idea that most people are good. We have to function on the idea that this business model and vehicle works, and this is a path to true wealth and financial freedom. And then we have to take the pragmatic step of controlling our risk, minimizing the chance this thing's going to go south on us. And that's learning. The big learning models there are, what are the risks? Can't control them if we don't know them. And what's a realistic return? I'm going to flip a bunch of houses or buy a bunch of rentals, make a bunch of money and retire. Sounds really good, but it's a rough business plan to execute on. We need a little bit more clarity than that. So while it really sucks to learn these things, like, should have done your paperwork a little differently when you did the lending deal, or maybe that multifamily underwriting was not as good as maybe you would do again today, right? Those are expensive lessons. Do you think you'll ever repeat them?
No.
No way.
Yeah, you've learned.
No
Hopefully the cost of that education is not very high, and in the end you make it out okay. If not, you paid for it. If the education program stopped you from making even one version of that mistake, it was worth it. One of the very first things I will do is a lexicon. We will go through a glossary of terms so that we are using the same words to mean the same things. There's a lot of marketing terms. They actually don't mean anything, or they might mean one thing in a particular community but mean something totally different somewhere else. A simple example is gator lending. That is a completely made up word. That's not real. That's a marketing brand. That's fine. There's nothing wrong with that. But when you use that term, the first question I have is, what does that even mean to you? Because unless you translated that to what the financial term is, from which the rest of the banking and finance industry uses, we could be talking about two totally different things. For all I know, you're trying to fund wildlife. What do I know? So all those words. But when you talk about doing things globally, this is really interesting. A lot of languages do not even have words for the concepts we're discussing.
Correct.
And it's absent. They just don't have them. One of my mentors teaches self-development in Vietnam, and it's very, very difficult because Vietnamese has no words for those kind of things.
Oh, wow.
Wow.
Interesting.
They don't have it. It doesn't exist. That doesn't exist. The concept doesn't exist in their language, which means in their cultural identity, it is absent. He has to build something completely new, a entirely new framework for them to even be able to conceive what he's talking about.
Wow.
Not because they're dumb or anything, nothing like that. It's just that the concept doesn't exist.
Yeah.
I'll give you guys there's actually, these exist in every single language in the world. We all have cultural blind spots like this, but I'll give you an interesting one. There is no language in humanity that contains a word. Well, if somebody has a dead spouse, that's a widow or widower. There is no word in any language for a parent who has lost a child.
For a parent that has lost a child. Oh, okay.
Doesn't exist. It's too painful.
Yeah.
As a human thing, we omit it from language.
Huh.
So there's an intentional one, but every culture has stuff like that. And so when we deal with cultures that don't have concepts like long-term goal-focused personal development or wealth building, there's no words to even describe these things.
Yeah.
And so you'd have to add that in. Not that I'm saying that's going to be a gigantic problem, but it is actually something to consider. And we begin with a lexicon so that we're speaking about the same terms. And anybody who has a question about what a word means, we would answer that before we even began talking about like investments or anything, or we might as well be speaking some magic other language. There are no words that translate. All right, guys. So hopefully you've learned a lot today about how we define risk in our real estate investments and how we go about controlling that risk. We went a little afield there talking about contractors and lending and some of the risks you see associated with that. So follow those underlying rules. It's more important to not lose than it is to win. The market dictates our returns, and whoever writes the biggest check makes the rules. And if you stick to those things and have a good idea of your own risk profile, you should have some very profitable investing in front of you. Thanks, and we'll see you next time.